Before we begin, it's crucial to understand that this presentation is for informational and educational purposes only. I am not a financial advisor, mortgage broker, or certified professional. The information provided in this video is not intended as financial, legal, or tax advice. The home loan process is complex and varies based on individual circumstances, market conditions, and lender requirements. You should always consult with a qualified professional, such as a licensed mortgage loan originator and a financial advisor, before making any major financial decisions. Your financial situation is unique, and the content here is not a substitute for personalized professional advice. There is a moment that shatters the American dream for nearly 200,000 people every single year. It's not a stock market crash or a housing crisis. It's a single, quiet, devastating word: denied. Imagine this: you've done everything right. You saved for years, picturing the backyard for the dog, the extra bedroom for the kids, the kitchen where you'll host Thanksgiving. You found the perfect house. You filled out a mountain of paperwork, bearing your entire financial soul to a stranger. You wait, refreshing your email 100 times a day, your heart pounding with a mix of hope and terror. And then the call comes. A polite, sterile voice on the other end says, "I'm sorry, but at this time, we're unable to approve your application." The dream evaporates. The house is gone. And the worst part? You have no idea why. For tens of thousands of people, this isn't a hypothetical story. It's a brutal reality. And the most painful truth is that for a huge percentage of them, it was completely avoidable. Their denial wasn't because they were broke or irresponsible. It was because they didn't know the secret rules of the game. They didn't understand how lenders actually think. Today we are pulling back the curtain. This isn't just another list of generic tips you can find on some bank's blog. This is the playbook. These are the 5 essential, non-negotiable truths you must understand before you even think about filling out a mortgage application. Mastering these 5 things will be the difference between getting that soul-crushing phone call and getting the keys to your new home. We're going to turn you from a hopeful applicant into a prime borrower, the exact type of person lenders are fighting to give money to. So let's get straight to it. The first and most misunderstood piece of this entire puzzle is your credit score. Now, you've heard it a million times. You need good credit to buy a house. Duh. But what does that actually mean? Most people think it's just about hitting a magic number. They hear 620 or 640 and think, "Great, I'm there. I'm ready." And that is the first and potentially most expensive mistake you can make. Your credit score is not a pass-fail grade. It's a headline. It's the cover of a book. Lenders, they don't just read the cover. They open the book and read every single word. And what they find inside tells them the real story of who you are with money. Think of it this way. If a friend, let's call him Bob, asks to borrow your brand new car, what's the first thing you think about? You're not just thinking about whether he's a nice guy. You're thinking, has Bob ever crashed a car before? Does he pay his debts? Does he bring things back in one piece? Your brain instantly calculates the risk. Lenders do the exact same thing, but with hundreds of thousands of dollars. Your credit report is your financial driving record. A high score might suggest you're a good driver, but the report itself shows them every speeding ticket, every fender bender, and every time you returned a car late. So what are they actually looking for inside that report? They are laser focused on 3 specific things. First, and most importantly, is your payment history. This is the undisputed king of your credit. It accounts for the biggest chunk of your score, and to a lender, it's a direct reflection of your character. Do you keep your promises? A single 30-day late payment on a credit card or a car loan from 2 years ago might seem like a small mistake to you. To a lender, it's a giant flashing red flag. It tells them that when push comes to shove, you might not pay them back on time. A 60-day late is worse. And a 90-day late? That's a 5-alarm fire. It can absolutely kill a mortgage application on the spot. Before you do anything else, you need to pull your full credit report. You can get it for free from the official government-mandated site, annualcreditreport.com, and scan it for any late payments. If you see one, especially a recent one, your first mission is to figure out what happened and if there's any way to get it removed, perhaps with a goodwill letter to the creditor if it was a one-time mistake. The second thing lenders scrutinize is what's called your credit utilization ratio. This is the silent killer of mortgage applications. You can pay every single bill on time every single month and still get denied because of this. Here's how it works. Let's say you have one credit card with a $10,000 limit. If you have a $5,000 balance on that card, your utilization is 50%. If you have a $9,000 balance, it's 90%. To a lender, high utilization screams one thing: you are living on the edge. You are reliant on credit to get by month to month. It signals financial stress. Even if you pay the minimum on time, a maxed out card tells a story of risk. The golden rule is to keep your utilization on every single card below 30%. But if you want to be a prime borrower and A+ applicant, get it below 10%. This is one of the fastest ways to boost your score. And here's a pro tip lenders don't tell you. Most credit card companies report your balance to the credit bureaus on your statement closing date. This means even if you pay your bill in full every month, if you make a big purchase, your utilization could spike for that month and temporarily tank your score right when the lender pulls your credit. The solution? Pay down your balance before the statement date, or make multiple payments throughout the month. The third element is the length and mix of your credit history. This is your experience level. Lenders want to see a long, stable history of you responsibly managing different types of credit. They call this a thick file. If your only credit history is a single 2-year-old student loan and a credit card you got 6 months ago, you have a thin file. It doesn't mean you're bad with money. It just means there's not enough data for them to feel comfortable handing you a $300,000 loan. They want to see that you can successfully juggle different kinds of debt, like an auto loan, a few credit cards, and maybe a personal loan, all paid on time over several years. This shows them you have financial maturity. This is why closing your oldest credit card, even if you don't use it, is often a terrible idea. That card is the bedrock of your credit history length. Cutting it is like chopping down the oldest tree in your yard. You can't just grow it back overnight. So your first mission starting today is to become the master of your credit report. Don't just know your score. Know your story. Know every late payment, every balance, and the age of every account. Dispute any errors you find immediately. Start aggressively paying down high-balance credit cards to get that utilization rate down. Because when that underwriter opens your file, you don't want them to see the story of a risky driver. You want them to see the pristine record of a financial professional who they can trust with their money. Mastering your credit is the foundational step. It's the price of admission. But it's only the first key. Because there's another number, a simple calculation that you can do on your phone in 30 seconds, that can disqualify even someone with a perfect 850 credit score. It's a number that reveals the single biggest secret about your financial life. And it's what we need to tackle next. This number is called your debt-to-income ratio, or DTI. And if your credit score is the story of your past financial habits, your DTI is the cold, hard prediction of your future. It's the single most important number lenders use to determine not what you deserve to borrow, but what you can actually afford to pay back, month after month, without ending up in financial ruin. Think of it like this. Imagine you're trying to carry a big, heavy box. Your credit score is like your reputation. It tells people you're a strong, reliable box carrier. But your DTI is a measure of how many other boxes you're already carrying. It doesn't matter if you're the strongest person in the world with a perfect reputation. If your arms are already full, you can't pick up another heavy box. The mortgage is that new heavy box. So how do you figure out this number? It's shockingly simple. You take all of your monthly debt payments, add them up, and then you divide that total by your gross monthly income. That's your income before taxes are taken out. The result is your debt-to-income ratio. Let's make this real. Meet Sarah. Sarah makes $60,000 a year. To get her gross monthly income, we divide that by 12, which gives us $5,000 a month. Now let's look at her debts. Sarah has a student loan payment of $300, a car payment of $400, and the minimum payments on her credit cards add up to $100. So her total monthly debt is $300 plus $400 plus $100, which equals $800. Now for the magic calculation. We take her total monthly debt, $800, and divide it by her gross monthly income, $5,000. The answer is 0.16. As a percentage, that's 16%. Sarah's DTI is 16%. To a lender, a 16% DTI is music to their ears. It tells them that only 16 cents of every dollar Sarah earns is already spoken for by debt. The other 84 cents are available for things like rent, utilities, food, savings, and most importantly, a new mortgage payment. Sarah is in a fantastic position. But here's where it gets critical. Lenders have very specific, non-negotiable lines in the sand for DTI. And there are actually two types they look at. The first is called the front-end ratio. This is simple. It's just your future housing payment, and that means the principal, interest, taxes, and insurance, often called PITI, divided by your gross monthly income. Most lenders want to see this number at or below 28%. They don't want you spending more than roughly a quarter of your pre-tax income just on your house payment. But the one that really matters, the one that disqualifies people, is the back-end ratio. This is the big one. This is your total debt-to-income ratio. It's your new potential house payment plus all your other existing monthly debts, all divided by your gross monthly income. And here are the numbers that can make or break your American dream. If your total back-end DTI is 36% or lower, you are a golden applicant. Lenders see you as extremely low risk. They will roll out the red carpet for you. If your DTI is between 37% and 43%, you're in the sweet spot for most conventional loans. This is considered acceptable and is where a huge number of approved borrowers land. You are a solid candidate. Now, if your DTI is between 44% and 50%, you've entered the danger zone. Getting a loan is still possible, but it's much, much harder. You might need what are called compensating factors, like a massive down payment, a near-perfect credit score, or significant cash reserves in the bank. Some government-backed loans, like an FHA loan, are more lenient in this range, but you will face intense scrutiny. And if your DTI is over 50%, for the vast majority of lenders, that's a hard no. The door is closed. It doesn't matter if you've never missed a payment in your life and have an 850 credit score. A DTI over 50% signals extreme risk. It tells the bank that one unexpected car repair, one medical bill, one bad month could push you over the edge and into foreclosure. Let me tell you about Mike. Mike was the perfect applicant on paper. He was a doctor making $240,000 a year. That's $20,000 a month. His credit score was a staggering 830. He'd been pre-approved by his bank's online calculator for a $1.2 million home. He found his dream house, made an offer, and it was accepted. He was ecstatic. Then he went to underwriting, the final step. And he was denied. Flat out rejected. Why? His DTI. You see, Mike had that $20,000 monthly income, but he also had $150,000 in student loans, with a monthly payment of $2,000. He drove a luxury SUV with a $1,400 monthly payment. And he had a few credit cards that he paid off every month, but the required minimum payment still totaled about $300. So his existing monthly debt was $3,700. The mortgage payment on his dream house with taxes and insurance was going to be about $7,500 a month. So let's do the math. His new mortgage of $7,500 plus his existing debt of $3,700 equals $11,200 in total monthly payments. Now we divide that by his $20,000 gross monthly income. The result? A DTI of 56%. The underwriter didn't see a successful doctor with great credit. They saw a person who would be spending 56 cents of every single dollar he earned before taxes just to service his debt. He was over-leveraged and a massive risk. The 830 credit score couldn't save him. His DTI killed the deal. So what can you do? This isn't just a number you're stuck with. You have immense power to change it. There are two levers you can pull. Increase your income or decrease your debt. Increasing your income is great, but it's often the slower, harder path. The fastest, most effective way to fix your DTI is to aggressively attack your monthly debt payments. Look at your debts. Do you have a small personal loan with a $100 payment? Focus all your extra cash on wiping it out. Once it's gone, that $100 is permanently removed from your DTI calculation. The biggest killer for most people is a car payment. That $500, $600, or $700 monthly payment is an anchor dragging your DTI down. Selling a car with a high payment and buying a more affordable one for cash, or just paying off your existing car loan, can be the single most impactful financial move you make before applying for a mortgage. It can literally be the difference between getting denied and getting approved for an extra $100,000. And under no circumstances should you take on any new monthly debt in the 6 to 12 months before you plan to buy a home. Don't finance a new phone. Don't get a new car. Don't buy furniture on a payment plan. Every new dollar of monthly payments is a dollar that you can't use towards your housing qualification. Your DTI isn't a punishment from the bank. It's a protection. It's a guardrail designed to stop you from becoming house poor, where you have a beautiful home but no money left over to live, to save, to enjoy your life. A high DTI means you're living on a knife's edge. A low DTI means financial stability and peace of mind. So you've got your credit score dialed in, and you've wrestled your DTI into the green zone. You're ready, right? Not quite, because the bank is about to ask you for a pile of cash, and I'm not just talking about the down payment. There's a second secret pile of money they expect you to have, and if you don't, your dream house could vanish right before you get the keys. And we'll break down exactly what that is and how much you need next. This secret pile of money, the one that blindsides so many first-time homebuyers, is called closing costs. And it's the single biggest reason that deals fall apart at the last minute. You can have the perfect house, the perfect credit score, the perfect down payment, and still lose it all a week before closing because you didn't account for this. So what are they? Think of it like this. Buying a house isn't a simple transaction like buying a coffee. It's a massive legal and financial process involving a dozen different people and companies: lenders, appraisers, lawyers, title companies, government record keepers, and every single one of them needs to get paid for their part in making that house officially yours. Closing costs are the collection of all those fees. They are completely separate from your down payment. You need your down payment plus a separate pile of cash for closing costs. So how much are we talking about? The general rule of thumb is that you should expect to pay between 2 and 5% of the home's purchase price in closing costs. Let me repeat that because it's a number that needs to sink in. 2 to 5%. On a $400,000 house, that's anywhere from $8,000 to a staggering $20,000. On top of your down payment, imagine you saved up $40,000 for a 10% down payment on that house. You're feeling great. You're ready. Then, your lender hands you a statement saying you need to bring $55,000 to the closing table. That extra 15 grand is the deal killer. It's the knockout punch nobody saw coming. So let's pull back the curtain and break down exactly what you're paying for, so there are no surprises. Closing costs generally fall into 3 main buckets. The first bucket is lender fees. This is what you pay the bank for the service of actually creating and giving you the loan. You'll see line items like an origination fee or an underwriting fee. That's the bank's administrative cost for putting the whole loan package together, verifying your income, and approving you. You might also see something called points or discount points. This one is tricky, but it's powerful if you understand it. 1 point typically costs 1% of your total loan amount. By paying for points up front at closing, you are essentially prepaying some of the interest to buy down your interest rate for the entire life of the loan. It's a trade-off. Pay more now to save a lot more later. If you plan on staying in the house for a long time, buying points can save you tens of thousands of dollars in interest. The second bucket is third-party fees. These are costs for services performed by people other than your lender, but that your lender requires to get the deal done. This is the longest list. You've got the appraisal fee. The bank needs to send a professional appraiser to the house to make sure it's actually worth the price you're paying. Why? Because the house is their collateral. If you stop paying, they need to know they can sell the house and get their money back. That fee can be $500 or $600. Then there's the home inspection fee. While technically not always a closing cost because you often pay it up front, it's a critical expense in the process. This is for your protection, not the bank's. You hire an inspector to find any hidden problems. A leaky roof, a cracked foundation, faulty wiring. Never ever skip this. Next up is title insurance. This one is huge and non-negotiable. A title company does a deep dive into the property's history to make sure the person selling it to you actually has the legal right to sell it. They're looking for old debts, liens from contractors, or a long-lost heir who might suddenly show up and claim the house is theirs. Title insurance is a one-time premium you pay at closing that protects you and the lender from any of these ancient claims popping up in the future. It's your defense against the property's past. You'll also see fees for credit reports, flood certification, and sometimes attorney fees, depending on which state you live in. Now for the third bucket, and this is the one that confuses everyone: prepaids and escrow. This isn't really a fee. It's you prepaying your own future bills. Your lender is going to require you to pay for your first year of homeowner's insurance upfront at closing. They also require you to prepay a few months of property taxes. Why? Because they have a massive financial stake in your home, and they need to make absolutely sure that the insurance is always active and the property taxes are always paid. If the house burns down and you let the insurance lapse, they lose everything. If you don't pay your property taxes, the government can eventually seize your home, even before the bank gets its money back. To handle this, they set up something called an escrow account. Think of it as a separate savings account that the lender manages for you. At closing, you deposit a lump sum to start it off. Usually a few months' worth of property taxes and a couple months of homeowners insurance premiums. This is the cushion. Then, every single month, a portion of your total mortgage payment isn't going towards the loan itself. It's being diverted into this escrow account. So your monthly payment is PITI: principal, interest, taxes, and insurance. When your property tax and insurance bills are due each year, the lender pays them for you automatically out of that escrow account. It's a forced savings plan to protect their investment, and honestly, it protects you from getting hit with a massive unexpected $5,000 tax bill once a year. But you have to fund that account at the start, and that's a big chunk of your closing costs. Okay, so your head is probably spinning. Origination fees, title insurance, escrow, it's a lot. And it adds up to a terrifying number. So how do you manage this? How do you avoid that last-minute heart attack? First, the law is on your side. Within 3 days of applying for a mortgage, your lender is legally required to give you an official document called a loan estimate. This document itemizes every single estimated closing cost. This is your roadmap. It's your cheat sheet. Study it line by line. If you see a fee you don't understand, ask your loan officer to explain it until you do. This document is designed to let you compare apples to apples between different lenders. Second, you can shop around for some of these costs. The loan estimate will actually have a section that tells you which services you can shop for. You don't have to use the title company your lender or real estate agent recommends. You can call 3 different title companies and see who has the best rates. You can save hundreds of dollars just by making a few phone calls. And third, and this is the ultimate pro tip, you can negotiate for the seller to pay them. That's right. In many situations, you can write into your purchase offer that the seller will contribute a certain amount or percentage towards your closing costs. This is called a seller concession. Let's go back to that $400,000 house with $15,000 in closing costs. You could offer the seller $410,000 for the house, but ask for a $10,000 seller concession. The seller gets the same net amount, but you now only have to bring $5,000 in closing costs to the table instead of $15,000. It's a creative financing strategy that can be the difference between getting a house and staying a renter. This is especially common with FHA and VA loans. It's a powerful tool in your negotiation toolkit. So closing costs are not just some minor administrative charge. They are a massive secondary financial hurdle you have to clear. By knowing what they are, budgeting for that 2 to 5%, scrutinizing your loan estimate, and knowing you can negotiate, you take control. You eliminate the surprise. You've now prepped your down payment, and you've prepped for the closing costs. You have the money ready. You've done the hard part, right? Wrong. Because all the money in the world won't get you a loan if you fail the next test. It's a single number, a 3-digit score that will dictate everything. Whether you get approved at all, how much you pay every month for the next 30 years, and how much house you can even afford to look at. And most people have no idea what actually goes into that number, or how to rapidly improve it. We're talking about your credit score, and we're about to demystify it completely. Think of your credit score as your financial GPA. It's a single 3-digit number, usually somewhere between 300 and 850, that sums up your entire history of borrowing and repaying money. To a lender, it's a crystal ball. It's their single best guess at answering the most important question they have about you. If we lend this person hundreds of thousands of dollars, what are the odds they'll actually pay it back on time? A high score screams responsible, trustworthy, low risk. A low score whispers, uh-oh, this could be trouble. Now, why does this one number matter so much? Because it doesn't just determine if you get the loan. It determines the price of that loan for the next 30 years. This is the part that most people tragically underestimate. Let's make this real. Imagine 2 friends, Sarah and Mike. They both have the same job, the same income, and they're both buying identical houses in the same neighborhood for $400,000. They both put 20% down, so they each need a mortgage for $320,000. Everything is exactly the same except for one thing, their financial GPA. Sarah has been diligent for years. She's paid every bill on time, kept her credit card balances low, and has an excellent credit score of 780. The bank looks at her and says, "You're a safe bet." They offer her a great interest rate, let's say 6.5%. Her monthly principal and interest payment comes out to about $2,022. Mike, on the other hand, has been a little less careful. He's had a few late payments over the years, and he tends to carry higher balances on his credit cards. His score is a 640. It's not terrible, it's considered fair, and he still gets approved for the loan. But the bank looks at him and sees more risk. To compensate for that risk, they give him a higher interest rate, let's say 7.5%. His monthly principal and interest payment? $2,237. Now you might be thinking, okay, so Mike pays $215 more per month. That's not great, but it's not the end of the world. But you're only looking at one page of the book. Let's read the whole story. Over the course of their 30-year mortgages, Sarah will pay a total of $408,000 in interest. Mike, because of that single percentage point difference, will pay a staggering $485,000 in interest. That is a $77,000 difference. $77,000 for the exact same house. Mike is paying the price of a brand new Tesla Model Y on top of his mortgage, simply because of that 3-digit number. That is the power of your credit score. It's not just a number. It's a multi-thousand-dollar decision every single year for the next 3 decades. So, if it's that important, what actually goes into it? How do they come up with this magic number? It's not magic at all, it's a formula. And while the exact recipe is a secret, the ingredients are public knowledge, broken down into 5 main categories. The first, and by far the most important ingredient making up 35% of your score, is your payment history. This is the king. It answers the most basic question. Do you pay your bills on time? Every single late payment, on a credit card, a car loan, a student loan, even a medical bill that went to collections, is a black mark on this report. A payment that's 30, 60, or 90 days late can be a wrecking ball to your score, and it can stay on your report for 7 years. The single most important thing you can ever do for your credit is to pay every single bill on time, even if it's just the minimum payment. Set up autopay. Put reminders in your phone. Do whatever it takes. Consistency here is everything. The second biggest ingredient at 30% of your score is called amounts owed, but a better name for it is credit utilization. This is a little more complex, but it's the secret weapon for rapidly improving your score. It primarily looks at how much of your available revolving credit you're using. In plain English, it's your credit card balances compared to your credit card limits. Imagine you have one credit card with a $10,000 limit. If you have a $1,000 balance on it, your utilization is 10%. That's fantastic. It shows you have access to credit, but you don't need to use it all. You're in control. But if you have a $9,000 balance on that same card, your utilization is 90%. To a lender, that looks like you're living on the financial edge. It signals risk, even if you're paying on time every month. A high utilization ratio can crush your score. The general rule of thumb is to keep your utilization below 30% on each card and overall. But if you want to be in the A+ student category, the Real Pros keep it below 10%. Paying down your credit card balances is the single fastest way to see a significant jump in your credit score. The third ingredient, worth 15% of your score, is the length of your credit history. Lenders are like historians. They want to see a long, well-documented track record. They look at the average age of all your accounts and the age of your oldest account. A longer history provides more data, giving them confidence that your good habits aren't just a recent fluke. This is why the common advice to close old credit cards you don't use is often terrible advice. That credit card you opened in college to get a free t-shirt? If it's your oldest account and has no annual fee, keep it open. Use it once every 6 months to buy a coffee to keep it active. Closing it is like tearing out the first chapter of your financial autobiography. You instantly shorten your history and can lower your score. Fourth on the list at 10% is your credit mix. Lenders like to see that you can successfully manage different types of credit. There are 2 main types: revolving credit, like credit cards where you can borrow and repay repeatedly, and installment loans like a car loan or a mortgage where you have a fixed payment for a fixed period. Having a healthy mix of both shows you're a versatile and responsible borrower. This doesn't mean you should go out and get a car loan just to improve your mix. That's a bad idea. But if you already have a mix, it works in your favor. And the final ingredient, also at 10%, is new credit. This category looks at how often you're applying for new credit. Every time you formally apply for a loan or credit card, it results in a hard inquiry on your report. 1 or 2 here and there isn't a big deal. But if you apply for 5 different credit cards in a month to take advantage of store discounts, it sends up a huge red flag. It makes you look desperate for cash, which is the last thing a mortgage lender wants to see. This is why once you start the mortgage process, your loan officer will give you a critical command. Do not, under any circumstances, open any new lines of credit. Don't finance a new car. Don't get a new credit card. Don't even get the 10% off by opening a store card for that new furniture you're planning to buy. Freezing your credit activity is paramount until after you have the keys to your new home in your hand. So, how do you put all this knowledge into action? First, you need to know your score. You can get free scores from dozens of places like Credit Karma or your credit card company. But here's a crucial insider tip. The score you see is probably not the exact score your mortgage lender will see. Most free sites provide a Vantage score. Lenders, however, almost always use a FICO score, and they often use specific, older versions of the FICO score designed for mortgages. They'll pull a report from all three major bureaus, Equifax, Experian, and TransUnion, and will typically use the middle of the three scores to make their decision. So use the free sites as a guide, but don't be surprised if the lender's number is a bit different. Now, we've covered the financial report card that is your credit score. It tells the story of your past, but lenders are equally, if not more, concerned with your present financial reality. They need to know if you can actually handle the monthly payment for the house you want to buy, on top of all your other existing financial obligations. They have a powerful and brutally simple calculation they use to figure this out. It's the other half of the approval equation, a single percentage that acts as the ultimate gatekeeper to homeownership. It determines not just if you can get a loan, but the absolute maximum amount the bank is willing to lend you, regardless of how perfect your credit score is. This number is your debt-to-income ratio, and it's what we're breaking down next. Imagine your entire financial life is a bucket. Your income is the water flowing into it every month. Your debts are the holes in the bottom of that bucket. The bank wants to know, before they add another, much larger hole for a mortgage, how much water is actually staying in your bucket at the end of the month. That, in a nutshell, is your debt-to-income ratio, or DTI. It's the single most important number lenders look at to determine your actual capacity to take on new debt. It's a simple percentage calculated by taking all of your monthly debt payments and dividing them by your gross monthly income. That's your income before taxes, health insurance, or anything else is taken out. Let's be crystal clear on what the bank considers debt. We're talking about any recurring monthly payment that shows up on your credit report. This includes your minimum credit card payments, car loans, student loans, personal loans, and any other mortgages or alimony or child support payments you might have. What it doesn't include are things like your utility bills, your cell phone bill, groceries, or car insurance. The bank is focused on your contractual credit obligations. So, you add up all those monthly debt payments. Let's say it comes to $2,000 a month. Then you take your gross monthly income. If you and your partner earn a combined $100,000 a year, your gross monthly income is about $8,333. You divide your $2,000 in debt by your $8,300 in income, and you get a DTI of 24%. Now, why does this percentage matter so much? Because lenders have very specific, non-negotiable thresholds. There are actually two DTI numbers they look at. The first is the front-end ratio, which is just your potential new housing payment. That's principal, interest, taxes, and insurance, often called PITI, divided by your gross monthly income. Most lenders want this number to be around 28% or lower. The second and more important number is the back-end ratio. This is your total DTI. It's your new potential housing payment plus all your other existing debts, divided by your gross monthly income. For a conventional loan, lenders generally cap this at 43%. It's a hard line in the sand. Some government-backed loans like FHA might stretch to 47, maybe even 50% in rare cases, but 43% is the magic number for most people. If your total debt, including your new mortgage, pushes you over that limit, you will be denied. It doesn't matter if your credit score is a perfect 850. The bank's algorithm sees you as a risk. To really understand the power of this, let's look at two different couples. First, we have Mark and Jessica. They're doing well. They have a combined annual income of $150,000. That's $12,500 a month. They have great credit scores, both north of 780. On paper, they look like the perfect candidates. They go to the bank, confident they can get approved for their dream home, which costs about $500,000. But then the lender starts digging. Mark has a $1,200 monthly payment on his new truck. Jessica has $800 a month in student loan payments. And together, they have about $500 in minimum payments on various credit cards they've been using for vacations and home furnishings. So their existing monthly debt is $2,500. A $500,000 mortgage with taxes and insurance is going to be roughly $3,500 a month. So, the lender adds their existing $2,500 of debt to the new $3,500 mortgage payment. That's $6,000 in total monthly debt obligations. They divide that $6,000 by their monthly income of $12,500. The result? A DTI of 48%. The loan officer looks up from their calculator, shakes their head and says, "I'm sorry, you're over the 43% limit. You're denied." Mark and Jessica are stunned. They make great money, they've never missed a payment in their lives. But their lifestyle choices, their existing debt, made them too risky in the eyes of the bank. The bank isn't just looking at their income. They're looking at where that income is already promised to go. Now let's look at another couple, David and Sarah. Their combined income is much more modest, just $90,000 a year, or $7,500 a month. Their credit scores are good, around 740, but not as pristine as Mark and Jessica's. For the past 3 years, however, they've been laser-focused on one thing: becoming debt-free. They paid off their student loans. They bought used cars with cash. The only debt they have is a $200 minimum payment on a single credit card they use for an emergency vet bill. They go to the same bank to apply for a loan on a more modest $350,000 house. Their potential mortgage payment with taxes and insurance is about $2,500 a month. The lender adds that $2,500 to their $200 of existing debt. That's a total of $2,700. They divide that by their $7,500 of monthly income. Their DTI comes out to 36%. The loan officer smiles and says, "Congratulations, you're pre-approved." David and Sarah, who earn $60,000 less per year than Mark and Jessica, are seen as the better, safer bet by the bank. Why? Because their financial bucket has fewer holes. They have more unobligated income each month, which means they have more of a cushion to handle emergencies. A job loss, a medical bill, a broken furnace, without defaulting on their mortgage. That's all the bank really cares about. They aren't judging your lifestyle. They're calculating the statistical probability that you will pay them back every single month for 30 years. A low DTI is the best indicator of that. So how do you fix a high DTI? You have 2 levers to pull. Increase your income or decrease your debt. Increasing your income is fantastic, but it's often the slower, more difficult path. Decreasing your debt is where you have the most immediate control. The fastest way to dramatically impact your DTI is to pay off an entire loan, especially an installment loan like a car loan or a personal loan. When you pay off a $500 car loan, that $500 is completely removed from the debt side of the equation. It is a one-to-one improvement. Paying down a credit card helps, as it lowers the minimum payment, but completely eliminating a fixed payment is a massive win. Think about the debt snowball or avalanche methods. The avalanche method, where you attack the highest interest debt first, saves you the most money in the long run. But the snowball method, where you pay off the smallest balances first to get quick wins, can be incredibly effective for improving your DTI. If you have a small personal loan with a $200 monthly payment, wiping that out is a huge psychological and mathematical victory before you apply for a mortgage. And here's the critical warning. In the 6 to 12 months before you apply for a home loan, you must go on a debt diet. Do not, under any circumstances, finance a new car, co-sign a loan for a family member, or run up your credit cards. Every single dollar of new monthly debt you take on directly reduces the amount of house you can afford. I've seen people get pre-approved, go out and buy $10,000 worth of furniture on a store credit card for their new house, only to have the lender pull their credit again right before closing and deny the loan because their DTI shot up. It is a catastrophic and completely avoidable mistake. Your DTI ratio is the bank's X-ray into your financial health. It tells them the story of your obligations and your capacity. It's not about how much money you make. It's about how much of your money is already spoken for before it even hits your bank account. Getting this number under control, ideally below that 43% threshold, is not just a suggestion. It is a non-negotiable prerequisite to getting the keys to your new home. So you've perfected your credit, you've mastered your DTI, and you have a down payment saved. You're ready, right? Well, almost. Now you have to prove it all. How do you actually document your income, your assets, and your financial history to a skeptical underwriter? The mountain of paperwork you need is staggering, and one missing document or unexplained deposit can derail your entire application. That paper trail, the ultimate test of your financial life, is what we're tackling next. So let's pull back the curtain on this paper trail. Think of it less as a pile of documents and more as the complete biography of your financial life for the last 2 years. Every page tells a story, and the underwriter, the person who holds the fate of your loan in their hands, is paid to be the world's most skeptical reader. Their job isn't to believe you. Their job is to verify you. Every single number, every deposit, every source of income must be proven beyond a shadow of a doubt. Your word means nothing. The paper means everything. Let's start with the basics, the foundation of your financial story. Proof of income. This is where most people think, easy, I have a job. But it's not that simple. Lenders need to see the most recent 30 days of your pay stubs. They're looking at your gross pay, your deductions, your year-to-date earnings. They want to see consistency. Is your overtime reliable, or was it a one-time fluke? Is your bonus guaranteed, or is it discretionary? They will dissect this. Then they'll zoom out. They'll ask for your W-2s for the last 2 years. The W-2 is the government's official record of what your employer paid you. This isn't just about one good year. They're looking for a stable, predictable pattern. A big jump in income is great, but they'll want to know why. A big drop is a major red flag. If you switch jobs, they'll want to see that the income is comparable or better, and that you stayed within the same industry. A sudden career change from a salaried accountant to a commission-based artist? That's a risk they might not be willing to take, no matter how much you're making now. Now, for my self-employed friends, the entrepreneurs, the freelancers, the gig economy warriors, take a deep breath. Your journey is harder. A W-2 is simple. It's a single number from a third party. Your income is a complex web of revenue, expenses, and deductions. Lenders don't look at the $100,000 you billed last year. They look at what you told the IRS you made after all your write-offs. They will demand your last 2 years of federal tax returns, and I mean all of them. Every single page, every single schedule. That home office deduction, the new computer, the mileage you wrote off. All of that brilliant tax strategy just reduced the income you can use to qualify for a loan. I have seen countless business owners who live comfortably but can't get a loan because on paper, their taxable income is too low. The lender will typically average your last 2 years of net income. So if you made $30,000 in your first year and $100,000 in your second, they won't use the $100,000. They'll use the average, $65,000. It's brutal, but it's their formula for stability. Next up is the part that trips up almost everyone, your bank statements. They will want the last 60 to 90 days of statements for every single account you have. Checking, savings, money market, brokerage accounts, even that one you barely use. And they will put these statements under a microscope. This is the financial autopsy. They are looking for 2 things: assets and red flags. First, assets. Do you have the money for the down payment, the closing costs, and some reserves left over? This is called verification of assets. The money needs to be what they call sourced and seasoned. Seasoned means it's been sitting in your account for at least a couple of months. Why? Because they need to know it's your money, not a last-minute loan from your buddy that you secretly have to pay back. An undisclosed loan is an undisclosed debt, and that can sink your entire application. This brings us to the single biggest landmine in the entire process: the large unexplained cash deposit. Let's say you sold your old motorcycle for $5,000 cash to help with the down payment. You go to the bank, you deposit the cash. To you, it's a simple, logical transaction. To an underwriter, a $5,000 cash deposit is a nuclear red flag. It's a mystery. It's an undocumented, unsourced, unseasoned bomb that just appeared out of nowhere. Where did it come from? Is it a loan from a relative? Is it mattress money you didn't pay taxes on? They will assume the worst. Any deposit that isn't from your regular payroll requires a paper trail. If you sell something, you need a bill of sale with the buyer's information and a copy of the check or money order. If you deposit cash, you need a detailed, signed letter of explanation and any proof you can possibly provide. Without it, the lender will likely disregard that money entirely, and if you were counting on it for your down payment, you're done. This applies to gift funds too. It's wonderful if your parents or a relative want to help you with the down payment, but it's not as simple as them just writing you a check. The bank needs to prove it's a true gift, not a loan in disguise. Your relative will have to sign a formal gift letter that explicitly states the money is a gift with no expectation of repayment. And then comes the part that feels incredibly invasive. The lender will likely ask for your relative's bank statement. They want to see the money in your donor's account, and they want to see the transaction of it leaving their account and entering yours. It's an exhaustive process, all designed to prevent one thing: fraudulent, hidden debt. So once you're under contract and the loan is in process, Your financial life effectively enters a lockdown. You need to act as if you're a financial ghost. Do not make any large purchases. Don't go finance new furniture for the house you don't even own yet. Don't buy a car. Don't even apply for a new credit card at Best Buy to save 10% on a TV. Each of these actions creates a credit inquiry and adds new debt, which can change your debt-to-income ratio and force the lender to deny your loan at the last minute. Yes, it happens. Don't change jobs unless it's a clear promotion with a higher guaranteed salary in the same field. Don't move money around between your accounts just to organize it. It creates a confusing paper trail that you'll have to explain. And for the love of all that is holy, do not make any undocumented cash deposits. Live off the money you have, keep your payroll deposits coming in, and pay your bills on time. That's it. Be boring. Your goal is to hand the underwriter a story so clean, so straightforward, so perfectly documented that they have no questions. Your paper trail must be a paper trail of trust. It's the proof that you are exactly who you say you are. A reliable, stable, and creditworthy borrower. Building that perfect financial biography is a monumental task. It's a marathon of printing, scanning, and explaining. But once you've assembled this impeccable package, once you've proven your financial stability, you might finally feel like you know exactly how much money you'll need to bring to the table. But the number you've been focused on, that down payment percentage, is just the opening act. The real costs, the ones that blindside so many buyers and can drain your savings account moments before you get the keys, are hiding in plain sight. These are the closing costs, and they are far more expensive and complex than you can possibly imagine. We'll uncover every single one of them next. Imagine you've spent months, maybe years, saving for a down payment. You've sacrificed vacations, skipped dinners out, and watched every dollar. You finally get your offer accepted on a home. You're ecstatic. You have your down payment ready, a $20,000 check with your name on it. Then, a week before closing, you get a document called the closing disclosure. You scan the numbers and your heart sinks. There, at the bottom, is a line item demanding another $12,000. In cash. Due in 7 days. This isn't a hypothetical horror story. This is the reality of closing costs, the single biggest financial shock for first-time homebuyers. They are the silent partner to your down payment, the fees for every single person and service that touches your transaction, from the loan officer who takes your application to the county clerk who stamps your deed. And they typically range from 2 to 5% of the home's purchase price. Let's put that in perspective. On a $400,000 home, that's not a few $100 for paperwork. That's anywhere from $8,000 to a staggering $20,000. This is the final boss battle of home buying, and you need to come prepared. So let's demystify this beast fee by fee. Think of closing costs in 4 main buckets. First, you have the lender fees. This is what you pay the bank for the privilege of borrowing hundreds of thousands of dollars. The biggest one here is often the origination fee. This is the lender's charge for processing, underwriting, and funding your loan. It's their primary profit center. Alongside this, you might see smaller charges like an underwriting fee or a processing fee. Sometimes these are bundled into the origination fee. Sometimes they're listed separately. The key here is to look at the total lender charges, not just one line item. Now, within these lender fees, you'll encounter a strategic choice. Discount points. This is one of the most misunderstood costs. 1 point costs 1% of your loan amount. So on a $300,000 loan, 1 point is $3,000. What does it do? It buys you a lower interest rate for the entire life of your loan. You are essentially paying interest upfront to reduce your monthly payment for the next 30 years. Is it worth it? That's a math problem. You have to calculate your break-even point, how many months it will take for the monthly savings to add up to the upfront cost of the points. If you plan on staying in the home long past that break-even point, it can be a brilliant financial move. If you might move in 5 to 7 years, it could be a complete waste of money. The second bucket is third-party fees. This is the money you pay to the team of independent professionals who have to verify and validate the deal. The first is the appraisal fee. The bank isn't just going to take your word for it that the house is worth $400,000. They hire a licensed appraiser to inspect the property and compare it to recently sold homes in the area to determine its official market value. This isn't for you, it's for them. It protects the bank from lending you more money than the house is actually worth. If the appraisal comes in low, it can throw a major wrench in the deal, forcing you to renegotiate the price, come up with more cash, or potentially walk away. Next is the home inspection fee. Do not confuse this with the appraisal. The appraisal is for value. The inspection is for condition. This is for you. This is arguably the most important check you will write in the entire process besides the one for the house itself. A good inspector will climb on the roof, crawl through the attic and scrutinize the foundation. They're looking for the 5-figure problems: a cracked foundation, a failing HVAC system, faulty wiring, or evidence of termites. Paying $500 for an inspection that uncovers a $20,000 problem is the best return on investment you will ever see. Never ever skip the inspection to save a few $100. The third bucket is for title and insurance. This is all about protecting your ownership. Before you can buy the house, a title company has to perform a title search. They act like financial detectives, digging through decades of public records to make sure the seller is the true owner, and that there are no outstanding liens or claims against the property from contractors, ex-spouses, or the IRS. This search ensures you're receiving a clean title. Once the search is done, you'll be required to buy lender's title insurance. This policy protects your lender in case the title search missed something and a claim pops up in the future. But notice the name, lender's title insurance. Protects them, not you. That's why you will also be offered owner's title insurance. This is usually optional, but it's a non-negotiable for any savvy buyer. For a one-time fee at closing, it protects you and your equity from any future title defects for as long as you own the home. Imagine 5 years after you move in, a previously unknown heir of the former owner shows up with the legitimate, ancient claim to the property. Without owner's title insurance, you'd be facing a legal battle that could cost you tens of thousands of dollars and potentially your home. With it, the insurance company handles the legal fight for you. The final bucket, and often the most confusing, is for prepaids and government fees. These include small things like recording fees paid to the county to officially document the sale, and potentially very large things like state or city transfer taxes, which can be thousands of dollars in some areas. But the biggest surprise for most buyers is the prepaids. Lenders require you to pay your first full year of homeowner's insurance premium upfront at closing. So if your policy is $1,800 a year, you need to have that cash ready. On top of that, you have to pre-fund your escrow account. An escrow account is simply a savings account managed by your lender where you'll deposit about 1/12 of your annual property taxes and homeowner's insurance premium with every mortgage payment. The lender then pays those bills for you when they're due. To get this account started, they need a cushion. So at closing, they will collect several months' worth of property tax and insurance payments from you up front. This can easily be $2,000 or $3,000 that most people completely forget to budget for. So how do you keep track of all this? The law is on your side. Within 3 days of applying for a mortgage, your lender must give you a document called the loan estimate. This is a standardized 3-page form that breaks down all your estimated closing costs. It's your first look at the numbers. Then, at least 3 business days before you're scheduled to close, you'll receive a similar-looking document called the closing disclosure. This is the final bill. Your job is to compare these 2 documents line by line. Most of the fees should be identical or very close. If you see a major increase in a lender fee, you have the right to question it. This 3-day review period is your final chance to understand every single dollar you're being charged. Now, the most important question: can you reduce these costs? Absolutely. First, you can negotiate with the seller to pay a portion of your closing costs. This is called a seller concession. In a competitive market, it's less likely, but you never get what you don't ask for. Second, shop around for your mortgage. Different lenders charge different origination and administrative fees. Getting quotes from 3 or 4 lenders can save you thousands. Third, for services like title insurance and homeowner's insurance, you don't have to use the company your lender recommends. You have the right to shop for those services yourself. And here's a pro tip: schedule your closing for the end of the month. At closing, you have to pay daily interest on your loan for every day left in that month. If you close on June 5th, you're paying for about 25 days of interest. If you close on June 29th, you're only paying for 2 days of interest. This simple scheduling trick can save you hundreds, sometimes over $1,000, in cash at the closing table. Now that you've mastered your credit, your down payment, and the hidden minefield of closing costs, you're ready to choose your weapon: the loan itself. But picking the wrong one, a 30-year fix when you should have an ARM or an FHA when conventional was better, is like bringing a knife to a financial gunfight. It's a mistake that can cost you tens, or even hundreds of thousands of dollars over time. And we're about to break down exactly how to choose the right one for you. So let's arm you for that fight. The 4 primary weapons you can choose from are conventional, FHA, VA, and USDA loans. Think of these as different classes of tools, each designed for a specific job and a specific user. Get this choice right and you're set up for success. Get it wrong, and you're fighting an uphill battle for 30 years. First up, the heavyweight champion, the most common mortgage in America, the conventional loan. This is the loan that isn't backed by a specific government entity. Instead, it follows rules set by Fannie Mae and Freddie Mac, those two giant corporations that buy mortgages from lenders. Think of a conventional loan as the varsity team of mortgages. To get on the team, you need to be in good financial shape. We're talking a solid credit score, typically 620 at the absolute minimum, but you'll get much better rates in terms if you're pushing 700 or ideally 740 and above. You also need a stable income and a lower debt-to-income ratio. The biggest advantage? Flexibility. With a conventional loan, if you put down less than 20%, you'll have to pay private mortgage insurance or PMI. But here's the magic trick. Once you reach 20% equity in your home, you can request to have that PMI removed. And once you hit 22% equity, the lender is legally required to drop it automatically. That's a huge long-term savings. Conventional loans are for the financially disciplined buyer who has saved up a decent down payment and has a strong credit history. If you fit this profile, this is almost always your most powerful and cost-effective weapon. But what if your credit isn't perfect? What if you haven't been able to save up a 10 or 20% down payment? That's where our next option comes in, the FHA loan. FHA stands for the Federal Housing Administration, and these loans are insured by the government. This insurance protects the lender if you default, which makes them willing to lend to borrowers with less than perfect credentials. It's like the government is co-signing for you. The benefits are obvious. You can get an FHA loan with a credit score as low as 580 and a down payment of just 3.5%. This is the loan that opens the door to homeownership for millions of people who would otherwise be locked out. It's an incredible tool, but it comes with a significant cost. Because the government is taking on risk, you have to pay for that insurance. It's called a mortgage insurance premium, or MIP. And unlike the PMI on a conventional loan, FHA MIP is a two-part beast. First, there's an upfront premium, which is usually rolled into your total loan amount. Second, there's an annual premium paid monthly that, and this is the critical part, for most borrowers lasts for the entire life of the loan. You can't just get rid of it after a few years. You're stuck with it until you sell the house or refinance into a different type of loan. So while FHA is a fantastic gateway, it's a gateway with a permanent toll booth. Next, we have a truly special loan, one that's earned, not just applied for, the VA loan. This is exclusively for eligible veterans, active duty service members, and some surviving spouses. It's one of the best benefits of military service, and frankly, it's one of the most powerful financial tools on the planet. The headline feature? Zero down payment. You can buy a home with literally nothing out of pocket for the down payment. Let that sink in. While everyone else is scraping together tens of thousands of dollars, eligible VA borrowers can walk in with zero. And it gets better. There is no monthly mortgage insurance. None. That PMI or MIP we just talked about. It doesn't exist on a VA loan. This can save you hundreds of dollars every single month compared to other loan types. Now, it's not completely free. There is something called a VA funding fee, which is a one-time charge that can be paid at closing or rolled into the loan. But even with that fee, the long-term savings are astronomical. If you are eligible for a VA loan, you need to put it at the absolute top of your list. It is, without a doubt, the financial equivalent of a superpower in the real estate world. Finally, there's the loan that too many people forget about, the USDA loan. This is a program from the U.S. Department of Agriculture, designed to help develop rural and some suburban areas. And you might be surprised what the USDA considers rural. It's not just farmland. Many small towns and suburbs on the outskirts of major cities qualify. You can check a property's eligibility right on the USDA website. Like the VA loan, the USDA loan has a show-stopping feature: zero down payment. Again, a path to homeownership without needing a massive savings account. The interest rates are also typically very competitive. So what's the catch? There are two. First, there are geographic restrictions. The home must be in an eligible area. Second, there are income limits. You can't make too much money. The program is designed for low to moderate income households. But if you meet the income and location requirements, a USDA loan is an absolutely incredible, often overlooked option that can save you a fortune. So how do you choose your weapon? Let's create a simple decision tree. Question 1. Are you a veteran or eligible service member? If yes, start by looking at a VA loan. It's almost certainly your best option. Question 2. If not, are you planning to buy in an area that might be considered rural or a small town? And is your household income within the local limits? If yes, you absolutely must investigate a USDA loan. It could be your zero down payment ticket to a home. Question 3. If the answer to both of those is no, then it's a head-to-head battle between conventional and FHA. And the decision comes down to your numbers. Do you have a credit score above, say, 680, and can you put down at least 5%? If yes, a conventional loan is likely going to be cheaper in the long run because you can ditch the PMI. Is your credit score a bit bruised? Or is your down payment closer to that 3.5% minimum? Then the FHA loan is your champion, your way into the game. The single biggest mistake people make is not understanding this choice. They walk into a lender's office and the loan officer says, "Oh, you only have 5% down? You need an FHA loan." That is not always true, and that advice could cost you a fortune. Let's run the numbers on a $400,000 house. With an FHA loan and 3.5% down, your monthly mortgage insurance premium will be around $230, and you'll pay that every month for 30 years. That's over $82,000 in mortgage insurance alone. Now, let's say you qualified for a conventional loan with 5% down. Your PMI might be slightly higher initially, maybe $250 a month, but you're paying down your loan and your home is appreciating. In about 6 or 7 years, you'll hit that 22% equity mark, and that $250 payment vanishes forever. In this scenario, the FHA loan costs you over $60,000 more than the conventional loan. That is a new car. That is a college fund. That is a life-changing amount of money left on the table simply because you were steered into the wrong weapon for the fight. Understanding these 4 loan types isn't just a suggestion. It's your primary defense against overpaying for your home for decades to come. You have to know which one you're aiming for before you ever talk to a lender. Because once you've picked your loan type, your weapon of choice, you're faced with another critical decision that can dramatically alter your monthly payment and your overall risk. You have to decide on the structure of the loan itself. Do you lock in a rate that will never ever change for 30 years? Or do you take a lower introductory rate that could skyrocket in the future? That decision between a fixed rate and an adjustable rate mortgage is our next essential step. And it's where a dream home can turn into a financial nightmare if you choose wrong. Let's dissect that choice. On one side, you have the 30-year fixed-rate mortgage. It is the bedrock of American homeownership. It's the strong, silent type. It's predictable. It's boring in the most beautiful way possible. Imagine signing a contract for your cell phone, and the company guarantees your bill will be exactly $100 a month every single month for the next 30 years. Not a penny more. It wouldn't matter if inflation went to the moon, if the company's costs quadrupled, or if they released 10 new better phones. Your price is your price. That is the promise of a fixed-rate mortgage. The interest rate you lock in on day 1 is the interest rate you will pay on day 10,950. Your payment of principal and interest will never ever change. This provides a level of financial certainty that is almost impossible to find anywhere else in modern life. It allows you to budget with absolute precision. You can plan for retirement, for college funds, for vacations because your single biggest monthly expense is a known, immovable constant. It's the financial equivalent of building your house on a foundation of solid granite. The downside? That stability comes at a small premium. Typically, the starting interest rate on a fixed-rate loan is slightly higher than the introductory rate on its riskier cousin, the adjustable rate mortgage. And if interest rates plummet a few years after you buy, you're stuck with your higher rate unless you go through the hassle and expense of refinancing. Now let's talk about that cousin, the adjustable rate mortgage, or ARM. If the fixed rate is a stable salary job, the ARM is a high-stakes commission gig. The potential for reward is higher, but so is the risk. An ARM lures you in with a siren song, a lower initial interest rate. This is often called a teaser rate. It means your monthly payments for the first few years will be noticeably lower than they would be with a fixed-rate loan. This can feel incredible. It might allow you to qualify for a slightly more expensive home, or it could free up hundreds of dollars a month in your budget for other things. But the key is in the name, adjustable. That low rate is temporary. An ARM is typically structured as a hybrid. You'll see terms like a 5-to-1 ARM, a 7-to-1 ARM, or a 10-to-1 ARM. Let's break that down. A 7-to-1 ARM means your interest rate is fixed for the first 7 years. That's your introductory period. After that, the 1 kicks in, meaning your interest rate will adjust once every year for the rest of the loan term. And here is the terrifying multi-trillion-dollar question. What does it adjust to? It's not arbitrary. Your rate becomes tied to a specific financial benchmark, an index like the SOFR, the Secured Overnight Financing Rate. Your lender adds their profit margin to that index and poof, that's your new rate. If the index has gone up since you got your loan, your rate goes up and so does your monthly payment. If it goes down, your payment goes down. You are no longer on the stable ground of a fixed payment. You are on a ship, riding the waves of the global economy. Now it's not the Wild West. There are safety features called caps. A periodic cap limits how much your rate can increase in any single adjustment period, say by 2%. A lifetime cap limits how much your rate can increase over the entire life of the loan, often 5 or 6% above your initial rate. But let's be brutally honest about what that means. If you start with a 5% ARM, a lifetime cap of 5% means your rate could eventually climb to 10%. On a $400,000 loan, that's not just a small bump. That is a catastrophic payment shock. Your monthly payment could jump by over $1,000. This is the gamble. This is the nightmare scenario we talked about. And it isn't just a hypothetical. It's a ghost of recent history. To truly understand the risk of an ARM, we have to go back to the years leading up to 2008. In the mid-2000s, the housing market was a frenzy. Lenders were handing out exotic ARMs like candy. They had incredibly low teaser rates that lasted for just 2 years, sometimes with interest-only payments. People were told, "Don't worry about the rate adjusting. Your home's value will go up so much. You can just refinance or sell for a huge profit before the payment ever jumps." It was a house of cards built on a fantasy. Imagine a young couple in 2006. They find their dream home, but it's a stretch. The bank says, "No problem. We'll give you a 2/28 ARM with a 3% teaser rate." Their payment is a manageable $2,000 a month. They move in, they paint the nursery, they feel like they've made it. For 2 years, life is good. Then 2008 arrives. The entire financial world implodes. The housing market crashes. Their home is suddenly worth $100,000 less than what they paid for it. Refinancing is impossible. Selling means a massive loss. And right on cue, their loan hits its first adjustment period. The financial indexes have gone haywire. Their interest rate resets from 3% to 7%. Their payment doesn't just nudge up. It skyrockets from $2,000 a month to over $3,300. A $1,300 a month increase, overnight. At the exact same moment their property value collapsed and the job market was evaporating. That is the ARM nightmare. Millions of families lived it. It was a primary driver of the foreclosure crisis that brought the global economy to its knees. Now, it's important to say that the laws have changed. The Dodd-Frank Act put in much stricter rules. The exotic and predatory ARMs of that era are largely gone. Lenders have to verify your ability to repay the loan at the fully indexed rate, not just the teaser rate. But the fundamental risk remains. An ARM is a bet on the future, a bet that rates will stay low or go down, a bet that your income will go up, a bet that you'll move before the adjustment hits. So, who should even consider making that bet? An ARM can, in very specific situations, be a powerful financial tool. Let's say you're a surgical resident. You know for a fact that in 4 years, you'll finish your residency and your income will triple. A 7-to-1 ARM could save you a significant amount of money during your lower earning years, and you're confident you can handle the higher payment later. Or maybe you are active duty military and you know you have orders to relocate in 3 years. A 5-to-1 ARM makes perfect sense. You'll sell the house and pay off the loan long before the rate has a chance to adjust. You get the benefit of the lower initial payment without ever facing the risk. But for the vast majority of people, especially first-time buyers who envision staying in their home to build a life and raise a family, the fixed-rate mortgage is the undisputed champion of peace of mind. The question you have to ask yourself is not, what is the cheapest payment today? The question is, what is the worst-case scenario, and could my family survive it? Lenders are required to show you this on the loan estimate. What your maximum possible payment could be if the ARM adjusts to its lifetime cap. Look at that number. Stare at it. If that number makes your stomach clench, if it would mean you'd have to choose between your mortgage and groceries, then the ARM is not for you. The small monthly savings during the introductory period are not worth the years of anxiety and the risk of financial ruin. Choosing between a fixed and adjustable rate is a decision about your personal tolerance for risk and the stability of your life plan. It's one of the most important forks in the road on your home buying journey. And once you've made that choice, once you've decided on the fundamental structure of your loan, it's time to zoom in on the fine print. Because hidden within the pages of your loan offer is a minefield of costs and fees that can drain thousands from your pocket if you're not paying attention. Mastering this fine print is our final, and perhaps most crucial step. Let's pull back the curtain on the single most important document you'll receive in this entire process: the loan estimate. This isn't just another piece of paper. This is your roadmap. It's a standardized 3-page form that every single lender is legally required to give you within 3 business days of you submitting an application. The government designed this form for one reason: to empower you, to let you lay 3 or 4 of these side by side and compare them, apples to apples, without any confusing marketing jargon. This document is your shield against surprises. Let's break it down page by page, because knowing how to read this is like having a superpower. Page 1 gives you the big picture, the 30,000-foot view of your loan. Right at the top, you'll see the loan terms. This is the DNA of your mortgage. You'll see the loan amount, and right next to it, the interest rate. Is there a little box check that says fixed or adjustable? This is $1 million question. A fixed rate is your rock. It will never change for the life of the loan. Your principal and interest payment in year 1 will be the exact same in year 29. An adjustable rate, or ARM, is more like a roller coaster. It might start lower, which looks incredibly tempting, but after a set period, say 5 or 7 years, it will adjust based on the market. Could go up significantly. In a rising rate environment, an ARM can be a ticking time bomb for your budget. Right below that, you'll see 2 of the biggest red flags in the entire mortgage world. The first is a prepayment penalty. Can you imagine paying off your car loan early and having the bank charge you a fee for it? It's insane, but it exists in mortgages. If you see a yes next to this, you need to ask your loan officer why, and you should strongly consider walking away. The second red flag is a balloon payment. This is a sneaky loan structure where your monthly payments are artificially low for a period, but then at the end of that term, you owe a massive single lump sum payment. It's a financial trap, and for a standard homebuyer, you should run, not walk, from any loan with a balloon payment. Next, look at the projected payments section. This is where reality hits. Many first-time buyers get fixated on the principal and interest number, but that's not what you'll actually pay each month. This table shows you the full picture, what we call PITI: principal, interest, taxes, and insurance. It will estimate your monthly property taxes and your homeowner's insurance premium, and then add it all together to give you your true estimated monthly payment. It will also show if you have mortgage insurance or PMI, which we talked about earlier. Pay close attention here. This table also shows you how that payment might change over the years. Why would it change? Because property taxes and insurance premiums almost always go up. The bank is required to show you this, so you're not blindsided in year 2 when your payment suddenly jumps by $100 a month. Finally, at the bottom of page 1, you'll see the costs at closing. This section has 2 giant numbers: estimated closing costs and estimated cash to close. The closing costs are all the fees required to create the loan. The cash to close is the big one. It's your down payment plus those closing costs. This is the exact amount of money you will need to have wired and ready on closing day. No estimates, no guessing. This is the number you've been saving for. Now let's flip to page 2. This is where the magic and the mystery really happens. This is the detailed breakdown of those closing costs. It's where lenders can hide junk fees, and it's where you can save thousands of dollars if you know where to look. The section is split into parts. Section A is origination charges. Think of this as the lender's fee for their service. This is what they charge you for putting the loan together. You'll see things like an application fee or an underwriting fee, but the most important line item here is points. These are also called discount points. 1 point costs 1% of your loan amount. So on a $300,000 loan, 1 point is $3,000. Why would you pay this? To buy down your interest rate. Paying points is essentially prepaying some of your interest upfront to get a lower rate for the life of the loan. Is it worth it? You have to do the math. Calculate your monthly savings from the lower rate and see how many months it would take to break even on the cost of the points. If you plan on staying in the house for a long time, it might be a great deal. If you might move in 5 years, it's probably a waste of money. Next is Section B, services you cannot shop for. These are fees for services that the lender insists on choosing the provider for. Things like the appraisal fee, the credit report fee, and a flood determination fee. The lender needs to trust these vendors, so you don't have a choice here. You just have to pay them. But then we get to the goldmine, section C, services you can shop for. This is where you become a savvy consumer. This list includes things like the title search, the lender's title insurance policy, and a pest inspection. The lender will give you a list of their preferred providers, but you are absolutely 100% not required to use them. You have the right to shop around. Call 3 or 4 different title companies. Get quotes. You can easily save $500 to $1,000 or more just by making a few phone calls. Don't ever skip this step. The rest of page 2 details other costs. This includes things like taxes and government recording fees, prepaid interest, and initial deposits for your escrow account. What's an escrow account? It's simple. Instead of you having to save up and pay a massive property tax bill once a year, the lender collects 1/12 of that bill from you every single month with your mortgage payment. They put it into a special savings account, the escrow account, and then they pay the bill for you when it's due. It's a forced savings account that protects both you and the lender. Now for page 3. This page is all about comparison and clarity. At the top, you'll see a comparisons table. This is designed to help you understand the true cost of the loan beyond just the interest rate. It shows you how much you'll have paid in 5 years and how much of that was principal. But the most important number on this entire page, perhaps in the entire document, is the APR, the annual percentage rate. People get so confused by interest rate versus APR. Here's the simplest way to think about it. The interest rate is the price of the house on the sticker. The APR is the out-the-door price. The APR takes the interest rate and then bakes in most of the closing costs and fees from page 2. It expresses the total cost of borrowing as a single percentage. This is why it's always slightly higher than the interest rate. When you are comparing 2 loan offers, if one has a slightly lower interest rate but a much higher APR, it means that the lender is bearing a ton of fees in the closing costs. The APR is the great equalizer. It allows you to see at a glance which loan is truly the better deal over its lifetime. Finally, before you sign on the dotted line, you will receive one last document. It's called the Closing Disclosure or CD. You will get this at least 3 business days before your scheduled closing. This is the law. It's a cooling-off period designed to protect you. The closing disclosure looks almost identical to your final loan estimate. Your job is to put them side by side and compare them line by line. The numbers should be almost exactly the same. If the interest rate has changed, if the fees in section A or B have gone up, if your cash to close number is suddenly thousands of dollars higher, you stop everything. You pick up the phone and you call your loan officer and your real estate agent immediately. You do not go to closing until you have a clear and acceptable explanation for every single change. This is your final checkpoint. This is your last line of defense. We've covered a tremendous amount of ground. From mastering your credit score and calculating your DTI, to understanding the real cost of a down payment, the power of a pre-approval, and now deciphering the fine print. These 5 pillars are not just tips. They are the fundamental principles of a successful and stress-free home buying journey. This isn't just about getting a loan. It's about securing your financial future. It's about making the single largest purchase of your life with confidence, clarity, and control. You are not just a borrower hoping for an approval. You are an educated consumer, an informed buyer who is now equipped to navigate this process. Ask the right questions and choose the best possible path for yourself and your family. You've done the work, you have the knowledge, and now you are ready.